Well, greetings and welcome to the Investment Strategy Brief for September 2024. In this month's episode, we want to get into both headwinds and tailwinds. One important recent tailwind is a Fed rate cut, finally 0.5% from the Fed. We're going to get into that. And really, this creates a good potential for continued expansion of the economy and some information, therefore some influences on the markets. But we're also, of course, as ever, focus on possible headwinds as well. Now, as it relates to the economy, I want to actually start with an update that we've actually reissued our report on long-term themes. So think of things like the fourth industrial revolution, securing strategic resources, shifting demographics, the new consumer, and productive competition, where we really dig into what we think will be the drivers of the longer-term economy and the markets. And of course, in 2024, as we've discussed before, artificial intelligence has been one of the big tailwinds. It's been talked about a lot. We included a nice article in our Outlook report, and there's a lot of optimism, but there are some sort of potential headwinds really related to when investors will actually see a return on their investment. So recall that we've talked about sort of possible investments in three categories: enablers and also hyperscalers, which we'll get into in a second. That sort of bucket of companies that are enabling the development and application of AI. Then the innovators are companies that are using AI to improve their processes and their services, et cetera. And then disruptors will be, and there's really not a lot yet, but think of it as companies that use AI to try to disrupt segments of an industry or an entire industry. So that whole framework is kind of important as it relates to this idea of things being a tailwind. And of course, we've talked about a number of examples of the application of AI. So think of these days the production of films or creation or editing of photos, the idea of drug discovery, the idea of these days some technology is starting to show up where you can just go into stores, pick out what you want and leave, and they're going to keep track of what you got and charge you for it. Or things like cyber security and threat detection, AI being used in a lot of different places. But again, as it relates to sort of the patterns that we're seeing those hyperscalers. So think of companies like Microsoft with the Azure platform, Amazon with AWS, and the Google Cloud. These are basically efforts to provide services to essentially make AI available, and they're making big investments. So, of course, there's going to be the question of when are we going to see a return on those investments? When will earnings really be significantly influenced? And another thing that this chart shows is, on one hand, a big increase in the demand for electricity for data centers, and then as well, I'd say it's showing that across industries, it's actually still really early days. So across a number of segments, it's still single-digit percentage of companies using AI to do business. So that just means there's a lot of upside as it relates to artificial intelligence. It remains in some ways, in terms of the optimism in the market, a bit of a tailwind, but that headwind just really relates to the expectation that earnings will, of course, be improved and that shareholders will ultimately see value from that. Now, as it relates to the economy overall, we've seen an economy that has surprised to the upside. And the consumer has been surprisingly strong. We're watching for a little bit of a slowdown there, but among other things, the consumer is likely buoyed by a wealth effect, the idea that the stock market is up, and essentially that makes people feel good in terms of their wealth, and so they're going to essentially keep spending. Now, we have a somewhat softening job market. We are watching for a slowdown when it comes to the consumer. And looking back at the economy more broadly, a traditional thing to watch is the manufacturing segment of the economy. And here in this case, we're looking at purchasing managers' indices, so surveys of business leaders in the manufacturing sector. These PMIs have fallen below 50. It means they're contractionary. And that is typically, not always, but often a sign of a slowdown in the economy. And so that's one sign that people have been keeping a very close eye on. But as it relates to the consumer anyway, we do continue to monitor earnings season and how CEOs, as they talk about earnings, will comment on different things, including the consumer. And the bottom line is we're seeing increased sort of modestly negative commentary about how the consumer's doing. So the darker boxes here are quotes that are a little bit negative. The green one is one that's still signaling the consumer's okay. But we're seeing things like the consumer being financially strapped, or pressure on their ability to spend, a slowdown in spending, that kind of thing. And so it's a kind of data that we're watching. It's a little bit, in some ways, I think, of a leading indicator relative to reports that are yet to come out. And in any event, as it relates to sort of the data we've watched, retail sales have held up reasonably well. And yet we know that, as we've talked about before, consumer sentiment and confidence are a little bit muted relative to sort of a balanced level and a long-term average. And the stresses with debt continue. So an increasing cost in debt, the interest payments on debt, and an increase in delinquencies. And so this is all sort of setting up for a recognition that this tight Fed policy has led to higher rates and ultimately some indications that we're starting to see a bit of a slowdown in the consumer, but a consumer who's been a bit resilient so far. In any event, let's turn to inflation and the Fed. So the Fed did cut rates. I'll explain their reaction, but the foundation for sort of their rationale for cutting rates comes down to two things. One, there has been a softening in the labor market, which has been by design, right? They want things to slow down, demand to slow down a little bit. But then number two, they've focused on inflation, of course, and we know that inflation had been elevated. But for the last 6 months, take the two measures here, the consumer price index and the producer price index, the CPI and PPI, basically have averaged right around, not quite, but right around 0.17% each month on average over the last 6 months. That 0.17 is the monthly equivalent of the Fed's 2% target. And so the Fed basically has data like this saying, well, inflation has cooled down. And so long story short, they were comfortable to cut rates. And when we sort of unpack the meeting, essentially with this half-point cut, you can see, for example, in the statement, quote, the committee has gained greater confidence that inflation is slow or moving sustainably towards 2%, and judges that the risks to achieving its employment and inflation goals are roughly in balance. So the idea of they're bringing into focus the job market. And you can see, for example, though, that they're going to be data dependent. We have a quote there about that. And even Powell in his press conference said, because everybody wants a plan, tell us your plan. The Fed's not going to tell us that plan. So you can see Powell said, quote, we are not on any preset course. We will continue to make our decisions meeting to meeting, so end quote. So they're going to be data dependent. In any event, at the September meeting, though, we got also the summary of economic projections. Remember, this is a report where they're polling the officials and then showing some statistics about the officials, each individual outlook, but on a statistical basis. So median, for example, is something that we focus on a lot. And here, the Fed's basically saying we've had a half-point cut. There's going to be another half point between now and year end, according to the SEP median expectations. They also are calling for, and I think they think of it as trying to dial to a strong GDP growth rate, so a growth rate around 2%. Above their long-term trend projection, and then a little bit of a bump up in unemployment, but not too bad, up to 4.4%. So just think of it as a recognition by the Fed. They believe that inflation is coming down, and that it's going to be close to the Fed's 2% target over time. Essentially, that they're orchestrating, threading the needle of getting to a soft landing. And so therefore, they're sort of forecasting out these cuts, a half point for the balance of this year, and actually the SEP is projecting another 1% in 2025. And so this has been well received. The market, generally speaking, responded positively. And once again, I'd say the market, as it relates to Fed funds futures, is a little more optimistic. So this green line, which is flat, that's the forecast from the Fed for the year-end 2024 Fed funds rate. And you can say they dropped it back down. That blue line represents the reflected view implied in the Fed funds futures contracts. And so the bottom line is that the market's actually expecting 3 more cuts as of at least the printing of this chart when it comes to the action between now and year end. So that's a little bit more optimistic. And that, in some ways, the rate cut and the expectation of the rate cut is a bit of a tailwind. But if the Fed disappoints, that becomes a little bit of a headwind. So that's why, of course, we're going to keep an eye on it. In any event, you can see here that there's a consensus view. This is GDP growth on a consensus view. When we look out to next year, the consensus estimate is 1.7%, and that's below the longer-term trend. And so, something that we're mindful of is a slowdown in the economy, but a soft landing. Now, we are mindful of a lot of different potential external events. So you can think of things like cybersecurity attack, for example. But of course, these days, we're very focused on what's going on, for example, with Israel and Hezbollah, an increase in the military action around the world, and that escalation risk is significant. We're keeping a close eye on that. And then as well, of course, the uncertainty of the U.S. elections. And so to kind of take a pause on the elections, we know, as we've talked about before, that all three segments of the U.S. government that are up for election are in play, right? The White House, it's sort of a toss-up. We can see the potential for a shift in the House of Representatives and a potential for a shift in the Senate. And as we watch things like what's important to people, essentially the polls are showing and surveys are showing that inflation and prices are really important to people. Jobs and a feeling about the economy is important to people. How immigration is handled. Those three topics are sort of the top three most important things. So what we will expect, of course, is for the candidates to be campaigning on these to a good degree, and others, of course. And so there's a lot of news cycles between now and Election Day. We'll keep everybody apprised. In any event, as it relates to the predictive models and the polls, one of the last big sort of events was the debate between Harris and Trump, where Harris did a much better job, Trump not so much, and so the polls sort of flipped around a little bit, and they're showing Harris modestly in the lead. But as we've talked about when it was the other way around, it's really a little bit of a toss-up at this point. The probabilities are really moving around a bit, and we'll wait to see, of course, how things unfold at the election. In any event, as it relates to why this is important for investors, obviously just the state of the country overall is super important. Volatility as it relates to uncertainty or unrest will be really important. But then also the policies that ultimately incoming administrations put in force, especially if they have unified government, we know that these, depending on how things land, we're going to see potential changes or reinforcement of policy in the financial sector and energy and alternative energy, defense, and then M&A, how tolerant there will be of big mergers or not, and then things like China trade and policy with China. So those are all things that are in focus that we analyze as we learn more about candidates, and then we take into consideration, even more importantly, once somebody wins, we take a sort of inventory of the incoming sort of power structure in D.C. Now, one thing to remember is volatility just in general tends to increase in October and November of election years. So we're sort of gearing up for increased volatility. These days that's particularly more important because in some ways the scale of both the fiscal and monetary support that came through the pandemic and the reopening from the pandemic really has created these scales and sizes of data, really what some are calling unusual distortions in the data. And given that, the uncertainty of the elections, maybe these geopolitical hotspots, we should expect volatility. Anyway, let's turn to the markets more generally. First, I'll mention, as it relates to interest rates, that the most recent data that we're looking at shows that the 2-year rate is now below the 10-year rate. So that's normal, right? An upward sloping curve as you go out in maturity. For a good amount of time, the curve was what's called inverted, where the 2-year rate was higher than the 10-year, and that's often a precursor to recession. So the fact that the curve is flattened back out and become modestly positively sloped is an indication that the market's sort of less worried about a recession, again, informed significantly by this Fed cut and the anticipation of more from the Fed. In any event, interest rates overall are elevated, which makes it a good time to be invested in fixed income. And what I would say is volatility. On the equity side, it's called the VIX index. On the bond side, it's called the MOVE index. Volatility remains up. So we're seeing a bit more volatility in rates and then correspondingly in fixed income. But overall, this is a very good time if you have, especially if you have long-term investment money kind of invested right now in cash, which has been a good yielding place to be, this is a really good time to work with your financial advisor to start to unwind that position and redeploy that money both into other longer term investments, fixed income, equity, alternatives, etc. And so it's something to, again, have that conversation about with your financial advisor, but I would encourage people to sort of take action to have a look at that. In any event, as it relates to equities, like we've talked about for a while, when we look at things on a cap-weighted basis, what is that classic S&P 500 index, essentially the market is trading near highs and essentially at a 23% premium when we look at price-earnings ratio to the 10-year average. So for all these tailwind-oriented things, artificial intelligence, the Fed now cutting, and we'll get into it, but basically earnings growth, increase in improvements in profitability. There's all of this stuff in terms of the better than expected economy and the support of the equity market that has supported equities going higher and supported equities staying where they are. Now, interestingly, when we look on an equal weighted basis, so we undo the influence of the bigger company on the measurements, we see that the equal weighted index is actually just modestly above the long-term average, just a 2% premium. That tells us that there are good investments in a diversified way across the equity market. Now, we often talk about the Mag 7 and the rest of the market. We want to understand how earnings growth it might influence PE ratios, and we sometimes get into the bottom right part of this chart, which just says that PEG ratio, price earnings to growth. Things are kind of even between Mag 7 and the rest of the market. But this month, I want to actually just simply focus on the upper right of this chart. And what this is showing us is that essentially the overall market is expected to have earnings growth that's pretty robust in the coming years, and especially from the Magnificent Seven, but also from the rest of the market. So what we're seeing anyway is improvements in profitability, improvements in earnings that and this is all driven by individual analyst work and the consensus view that's sort of built up from that. And so the bottom line is there's optimism about the future of earnings in the coming years. And that really is a tailwind to the stock market. Not so much that we're in an environment, even with the Fed cuts, that we should expect the market to really take off and go higher. But because we're already at pretty elevated levels, these are forces that essentially serve as a tailwind to rationalize and kind of allow investors to be comfortable with those levels. And so again, overall net, it's been a positive environment for stocks. Now, another factor here is the idea that the market, again, is broadening out. And so when we look at fiscal year 2025 estimate of earnings growth, you can see it isn't just about tech, right? You see sectors like healthcare and consumer discretionary and industrials and materials. So the idea of earnings growth around the market really is sort of broader than just the big tech companies. And so that's good. That's healthy for the market environment for sure. We talked about when it comes to the patterns of performance that really as we got through the middle of the year, we started talking about a rotation. People were really enamored with the large cap oriented cap-weighted indices like the S&P 500 that had done really well. And the bottom line is there's been a bit of a rotation there where since July 10th happens to be the date when the rotation started, you can see that the equal-weighted, so adjusting and making the bigger companies sort of the same size, if you will, of others for purposes of measurement, you can see that index is up 7.9% from July 10th through, in this case, September 19th. And that's a little over 6% more than that cap-weighted S&P 500. That's influenced by the fact that over this measurement period, the Magnificent Seven, for example, is down a little over 6%. So a little bit of a give back and therefore broadening out. And yet, even though there's that negativity in that big tech area, overall the market's up, right? And so that's actually good. I think good in terms of a broadening of the market and a shift away from that one concentrated thing, which we've been talking about. You can see that, by the way, in the Bloomberg US 2000. That's a small cap index up over 10% over that last period that we're mentioning. And as it relates to these rotations, we are watching for, this happens to be rolling one-year returns, but think of it as periods when the cap-weighted index does well, then sometimes when the equal-weighted index does well, and we're sort of setting up for a rotation back to that equal-weighted dominance for some period of time. It's all about, as we've talked about before, staying the course. And by the way, we're going to start sort of bringing in that same kind of view on non-U.S. stocks. So really, since the financial crisis, U.S. equities have done better than non-U.S. equities, and there's some structural reasons for that. But we're sort of watching as companies do what they do out around the world, essentially for the potential of a rotation there. And it does argue ultimately for being diversified. And you can see in the past there have been periods when the non-U.S. markets have really dominated. And so we're going to start talking a bit more about that idea of diversification and rotation that we might anticipate as we move forward here. In any event, as it relates to looking forward, I'll just mention we are, of course, always watching the data. We're going to keep an eye on the consumer and the Fed, business data, retail sales related to the consumer, et cetera. And, and of course, all the different geopolitical tensions and honestly wars that are going on, as well as the election. So a lot to sort of keep an eye on between now and into and through the end of the year. So more to come in future episodes. In any event, as ever, I'll close by inviting you to check out stifelinsights.com, where this series and a bunch of other work is hosted. Thank you so much for being part of this month, and we'll see you next month. Thank you.